And we're live. This is This Week in Coverager. This is the podcast where we discuss some of the hot topics of the week in insurtech, fintech, edtech, or some combination of those, but articles that have appeared on Coverager. My name is Nick Lamparelli, as I'm in podcasting headquarters in Springfield. No, I'm in Naples, Florida. Sorry. Hope you enjoy the background. And as usual, in New York City, I have my co-host, Avi. Good afternoon.
Hello. Hello.
And we have a guest host. And this is going to be, we hope, a recurring thing where we can have experts in different areas of insurtech, insurance, fintech, and all of those who can come in and sort of give it a little bit additional insight versus, the kind of the opinions of Avi and myself, where I think we're fairly boisterous. So Mitchell Harrod is joining us, and he used to be vice president of marketing at Metromile, and is currently the marketing strategy consultant to Harrod, which is State Farm's UBI startup. And you're going to see that couldn't have picked better timing. So Mitchell, welcome.
Thank you. Thank you for having me. I've really been enjoying the show.
Yeah, thank you for coming on. Appreciate it. And so I'm going to kick it over to Avi to talk about, I think, what will be the one and only topic, but a fairly big one for this week that's ending Friday, September 25th. So Avi, what was the hot topic of the week?
So the big topic, of course, Root. It was reported by Reuters that Root is hired Goldman Sachs for an IPO. They're looking for an IPO. If you read Coverager, then it shouldn't surprise you. We told you a little bit about recent job openings that the company was looking to fill, which indicate that the company is looking for an IPO. So before, we kick it off, Mitchell, what is your impression of Root?
Sure. So, my view of Root has been as a competitor in the UBI space, and certainly they're competing with every traditional auto insurer as well. It's a very mixed story. There's a lot there that certainly as a competitor and as a marketer, I find really impressive and I tremendously respect. Most importantly, they came at customer acquisition through a completely brand new model, really brought a lot of innovation to the table, created something that resonates quite clearly with consumers. And they're figuring out how to get them in the door pretty affordably and at scale. And that's impressive. No doubt about it. The flip side of the coin, they're losing money on all those consumers. And they had been for some time, and it looks like they're going to continue to do so for some time. And, in insurance and financial services, it can be really easy to sell the product. It can be a lot harder to sell it to the right people. Sometimes that's part of the strategy, and sometimes it's some things about your business you need to get right. So, a lot to see how it plays out there.
Yeah, I think their timing couldn't have been better. So you brought up its unprofitability, and I think given Lemonade's IPO, I think they're really could be timing this like really well in terms of the types of investors that are willing to sort of overlook that. And so a question I would have for you, Mitchell, is that given the unit economics of this, what would be some of the potential downside to them if they, or let me flip this around. Sorry, is this a pricing thing where they could raise the price, or is there what sort of alternatives do they have to try to get profitable? How would that affect growth?
Sure. So, there's a number of levers there. I mean, ultimately, it's always pricing, right? It's, are they pricing risk appropriately? And I think the key thing is, and nobody outside the company really knows, to what extent may they be purposely underpricing as a way to attract that business with a plan of, we're going to cross-sell products, raise prices later, or shift the mix as we go. So, certainly can't sit here and say that they're not getting exactly what they're trying to do. However, my strong sense, and that of many others in the industry, is that they are casting a pretty wide net, growing incredibly fast. I was actually just looking at their state coverage map this morning, and I think since I looked at it even just a couple months ago, they've added another 6, 7, 8 states, each of which of course is going to be a unique market with unique pricing. it seems like a pretty substantial amount of unchecked growth, with a really keen focus on the top line mattering the most. And again, certainly respect the results if that's the goal. But where it flows through has created a situation where their survival is dependent on continuing to raise massive 9-figure slugs of equity. And certainly an IPO could position them well for a longer period of time to keep that going. But at some point, the musical chairs stop, and you need to be generally self-sufficient. And so, your choices for doing that are continuing to raise prices, narrowing your underwriting as you go forward, which is going to slow growth, being more selective in who you take on, or perhaps, they know more than we give them credit for, more than we realize, and the opportunities they have on cross-sell and some other things.
You mentioned the goal and what is the ultimate goal. I think that's the ultimate question. Obviously, it's very difficult to build an insurance company the right way when you're under a timetable. You raised a lot of money, you need to grow really fast. So sometimes that doesn't go hand in hand. But I think Root did a lot of smart things. Obviously, their model is no different than Progressive or Geico. They don't have any unique insights. They claim they do, but that's not true. But they keep on with this perception, and Sheffy likes to say that perception is reality. That's the message that they deliver. We're different, we're fair, we track how you drive. There's so many issues with the model, but because they are so vocal, because they do come with a very unique model that's unlike any other in the industry. Just now, Progressive kind of went that route a few months ago, saying, hey, come try us before you buy, and we'll give you a quote. So they're reacting, which is that by itself, I think, is an accomplishment to get Progressive to react. But no one is really doing what Root is willing to do, and that's why they're seeing that growth. And as you said, Mitchell, it's going to take them to the next step. They're going to go for an IPO, which is probably going to do good for the company. And then the real game starts with maybe they could do other things. They'll have more buying power, and they could really sit down and try to figure out what their true model is. Of course, consumers, not all consumers have a short memory, and their model is very problematic with the fact that when you say that you offer a price based on how the consumer drives, and the consumer doesn't have tickets or any violations, and renewal, there's an increase, that consumer is saying, what's going on? Why should I stay then?
Absolutely. I think there's, to me, it's more sort of the things that they don't talk a lot about that raise some of my concerns. For example, I'm in California. There is no UBI in California. So how am I being priced by them, and what advantage do they have versus anybody else? As a newer carrier in the state, they're at a disadvantage. They don't have a book. They don't have experience here. When I look at their renters and their homeowners and products, I'm unable to discern what meaningful advantage they have versus any other carrier that's been doing that for many, many years. And, those things are sort of, certainly on the margins where a lot of that growth has come from. I also find it really curious on the claim side of things. And one thing that could be opportunity to come or opportunity missed, with sort of the unusual pricing of we're gonna evaluate your driving in those initial 2, 3, 4 weeks of your term. You're giving up what I do think is that really strong value, and what I've seen is that really strong value of the telematics, and that's on the claim side of things. And it seems that data, I believe, my personal opinion is that data has higher value in claims than it does on pricing. They have the opposite view, it seems. But to even not require that data, which means in some cases you're not collecting it, the ability to leverage that to bring down your claims and their sky high LAE, those are things to me that raise some flags about how valuable, how much is it data usage, and how much of it is a great story to tell.
Well, Nick, this is a question for you in terms of, the claims. The whole concept of, the Root model is to attract better drivers. That's their concept. And they have a lot of claims. So do you think it's a case where for 2 to 3 weeks, I'm going to drive like my grandma, I'll get a rate from them, and then I'll just be my usual self?
Well, I think Mitchell will agree with this. That's kind of like the history of insurance. The biggest issue that we've run into is misalignment, where you have either a moral hazard or adverse selection. You're attracting the wrong customer. The customer that's attracted. I don't know of too many situations where the the customer has been attracted by the price and that has worked out well, frankly. And so being a low cost provider is actually like a really dangerous position to be in. And so I think of, for auto, I usually think like Geico as being, one of those companies that I would classify as is competing with the low cost, but they have like significant actuarial models for the types of accounts they want to go after where they can price it. They have a long history of being able to do that. But I think more importantly, they're backed by a company with an absolutely gigantic balance sheet. And so in order to be the low cost provider, you have to have assets. Like you need to be able to slim your margins down on your underwriting to razor thin areas and make up for it somewhere else. And I always wonder, like, Mitchell, maybe you can answer this. Like with the telematics, does it provide enough oomph on the underwriting side to overcome? Assume someone has no float. Assume, and in Root's case, they likely don't have anything that's significant. Will the telematics give them a competitive advantage on the pricing where they could leverage that to the low cost? I don't think the economics would work, but you know more about how that works. It just doesn't seem like there's enough oomph there to be able to get that sort of advantage.
Yeah, I mean, my view on telematics data, especially for pricing, is it's interesting, but it tends to generally be secondary. If you could tell me I could only use 3 or 4 data points, which some states like California effectively do, I'm going to look at things a lot more like gender, age, zip code, credit quality, California, driving history, things like, are you a hard breaker? Do you accelerate? Those are certainly interesting things to know, but I wouldn't put them as primary pricing factors. And so, Root, again, I don't know their pricing specifically. They claim in their marketing materials that the UBI data is more than a third of how they underwrite. And they've made the claim that they want to actually move off of credit data completely in the years ahead. There's always, I definitely believe, and we've seen it in a lot of industries, especially in financial services, that there are alternative data sets as data becomes just mushrooms in size in everything we do. I absolutely believe that the way we're doing things is never as good as it can be. But I do cast a somewhat dubious eye on what the incremental value of the telematics data is from a pricing perspective. The other thing that I find really curious is Root has a strong need to improve that book through a higher quality customer and usage of pre-screened credit data to market to customers, identify people with good credit who are likely to convert and likely to be quality customers. It's a pretty proven and effective strategy. I haven't seen them doing much of that in the market. They're not a big direct mailer, for instance. Their online seemingly tends to be, targeted a little more broadly and not through pre-screened credit. For them to make a statement that, the future actually is us to move the opposite direction, it's a big bet. And I don't know that they've, again, nobody knows, and perhaps they do have it all figured out and it's just in early days. But it seems to me a lot more tech and a lot less thin or insured.
Yeah. I think, we've seen with Root in recent years, they started to increase rates significantly, made a lot of consumers unhappy, which is obviously, the case with insurance. So, you wonder, what are they going to do? Because, this is their model, the way they do a lot of YouTube advertising, for example, a lot on Facebook and things like that. They're targeting a very specific customer. Yes, they have a renters and homeowners product now, but I don't know if someone a bit more sophisticated with a bit more money is going to do the test drive, keep their app on and do the whole thing. So you wonder what they're going to do, but I can tell you why I like their strategy, and it's not from a good place. So there are so many new drivers coming into the market every year. and not many know about Root. Like in InsurTech terms, Root is a big player. Everybody knows Root, but compared to Geico Progressive, not everybody knows what this company is about. And I believe the driver of potentially saving money, 50%, 52%, whatever that is always going to be very appealing. And this is something they're not afraid to promote. Like if you go and look at other insurtechs in the car space, they talk about get better rates or fair coverage, or what is that? Like 52%, I see the number. I know what 52% means because I know how much I'm paying. And they're very aggressive about that. And it really is helping them grow. And I wonder when they go for an IPO and they show their real numbers, it will be interesting to see who has a better cost of acquisition, Lemonade or Root. To me, obviously, you cannot compare renters to car insurance, but two companies that took a very different approach. And really, Root is the thing you could give them credit. And I think that's a huge advantage. They're not afraid to make customers angry. They're not afraid to make customers angry. They're not afraid to lie, and they lie in a lot of their advertisements, because if you say 35% of your rate is based on how you drive, and I'm paying $100 now, but next renewal, my cost is now $200. Is it still 35%? If nothing has changed? How does the math work here? So that's the thing about Root. They're not afraid to, I mean, it's misleading customers. There's no other way to put it. They're not afraid to do it. They're growing. Some customers, yes, they see the savings. They're happy. Some are not seeing the savings. And this is like a complete, to me, like the opposite direction of Lemonade. Lemonade went all in to please consumers as much as possible with the claims, automatic claims whenever they can. They kept the rates as low as they can for a long time. Now they're increasing, $1, not a big deal. But these are two companies that are not afraid to be out there and do what is necessary to acquire customers, because really you can't just say, oh, we're different.
Yeah, well, I agree with that in a lot of ways, but I'm also wondering, Mitchell and Avi, there are other competitors. Mitchell, you were from Metro Mile. Now you're in a lab for State Farm. Progressive's starting to roll out UBI. So I'm thinking from a defensible position, is it defensible? Like they already have competitors. I think it would be, I don't want to say it would be fairly easy for a lot of legacy carriers to come in, but it doesn't seem like UBI by itself provides anything that's going to be defensible.
Well, you forgot to mention Allstate and Liberty Mutual and others. And certainly I've seen even Allstate in particular, that, their pay-per-mile and their UBI products are a lot more front and center than they were even 6 months ago in their marketing. And, I think there's opportunity in the marketplace right now for Root and other upstarts to really develop UBI products. I think what you're seeing with the incumbents is, they're in the risk management business and it's a hedge. I think there's probably pretty wide acknowledgement that telematics has data, and in some shape or form, it's going to be the wave of the future in some shape or form. But that probably comes at the expense of profitability on the current book. And so, you see pretty much every major rolling forward with some shape or form of telematics, a lot of them being walked out pretty slowly. No one seems to want to dive into the pool until somebody else does. But that really, to me, looks like an anvil hanging over Roots and other carriers' heads. I think the more successful Root is, I think the faster they bring that competition into the market.
Yeah.
And it is in the ready position. And then, you've got the challenge that every upstart carrier has, which is Root doesn't have the brand that everybody else has. I mean, Root isn't even probably the third or fourth best known insurer out of Ohio. And so, their success is going to breed that competition. I think that competition has been moving slowly because it does cause profitability issues with the current book. But once one of them dives in, they're all going to dive in pretty fast.
Avi?
And well, that, I mean, is the ultimate question. And, when we were with Asaf on the podcast, and he was talking about, is a big company, is a big insurer going to risk what they currently have to experiment and see if it's valuable? And that is the ultimate question. I think most people understand that telematics data, right now, the smartphone-based telematics is a broken product. You don't really know. You don't know who's driving. You think you do. That's what they claim. That's not the case. When automakers are really going to go into UBI and they're going to say, hey, Nick, I know that you're not looking on the road. I'm going to stop the car. Then insurance companies are going to say, oh boy, you're really preventing risk now. I want to be on board. Then we'll see a lot of competition. But I don't see any insurance companies willing to go, like even Progressive, when they launched their new product in a clear attempt, against Root. I don't see Progressive going and telling customers, you could save up to 50%. I don't think they'll do that because, they have a reputation. As you said, Mitchell, they have a brand. They don't want to risk it. So I don't know if really anyone is going to go after them from insurance. But once, the trick is kind of discovered, then people are going to say, if there's any value, we'll do it. But I don't see any insurance company willing to play the exact game as Root.
Well, so you're getting into something that's interesting here, because Mitchell already brought up California doesn't allow UBI. So that's
hold on, but with Tesla, I don't know, but Tesla is talking about using it, and they're very confident that they'll be able to use telematics. And the commissioner is saying that they're open to discussions. So maybe Tesla knows something that we don't, and maybe Tesla is the company that will get California on board because Tesla is a real brand, not like others.
Okay.
But it will be interesting to see what happens.
Okay, so Mitchell, could that happen?
Yeah, I think eventually, as you see it propagate through different states, California will, in some shape or fashion, come on board as well. They're not there now, but certainly I think that's a train that's slowly moving down the tracks. I think the big issue with telematics and competition is, from the consumer perspective, it's a double leap of faith. It's not only I'm going to try out this new kind of insurance that prices things differently, and everyone thinks they're a good driver, but what if they're not? So you sort of have this risk of, I'm being judged. I think it's going to work for me. I think it's going to help me save some money. And I'm going to try it with this little or unknown brand. Who are they going to be there when it's time for a claim? And so, certainly as you get past sort of, the youngest consumers for insurance, who tend to be more adaptable to those things, there are plenty of people our age and older who say, you know what, I'm happy to save 15% and go with a Progressive or a Liberty Mutual or State Farm, than maybe save 30% with this company that might not be there or jerk me around when I finally have a claim.
Well, I'm thinking of the Lake Wobegon effect. So how many people actually think they are better than the average driver? I think a lot of people think they're better than the average driver. And I think a lot of people would be wrong about that. And so that gets to the, total addressable market. All you have to do is drive on the roads. People are pretty bad. They're not, and there's not enough law enforcement that you can have out there. So for the most part, how many times have you guys driven like at 65 miles an hour on the highway? Like
every time, officer.
Well, that's the right answer on this. I would say, Mitchell, most other people I see on the highway are going much faster than that. And so you see all of, people that are, sneaking through the yellow to red light, going through yields without looking. I would say it's the majority of people would probably begin to fall outside of what some algorithm would say is good driving. Therefore, if that's the case, and if people are being judged on that, and then ultimately priced on that, my guess is that ultimately they're going to get some sticker shock, and it's going to be they're going to say, screw this. So I think there's like a double-edged sword here, in that it could prevent the size of your market. You could, with a low price, you can get this, big market share, and then once your UBI really kicks in, if the regulators allow you to do it, it could be that situation where, like I described, where you're getting punished. Hey, you're going 75 and a 65. Hey, you're doing all of these different things that we consider to be predictive of, poor driving, and we're going to charge you that, and then they're going to leave, which might be good because it might leave you with like really good drivers. But it gets to me, the IPO and where that valuation goes. That's what I'll be looking at. I have no doubt that they can be a successful company, just like I have no doubt Lemonade can be a successful company. But I see enough roadblocks in all of these things that are coming around that it's like there are natural governors in the system where it's like I don't think they can get that big with just that advantage.
Well, so you touched on something there, Nick, that I think is important, and that's kind of the big brother effect of all this. You are consenting to being watched in all you do, and you are rewarded or punished based upon it. And again, I think sort of what's one of the steepest challenges for any insurance upstart is, brand, credibility, legitimacy, and trust. And in this case, where you are giving consent through your phone, through your car, through a third-party plug-in device, for someone to watch every single thing you do and judge you and presumably punish you when you go wrong, again, a lot of consumers are awfully wary about doing that, period. When I can watch, State Farm or Allstate commercials and feel good about these companies that have been around for decades and have established that credibility and trust, I'm going to be more willing to go in that direction than who the heck are these guys.
Yeah.
And
Avi,
that's really one of the big headwinds that I think
yeah.
is understated in this industry.
So here's a potential another headwind, Avi. How many articles do you think Coverager has posted on autonomous vehicles?
Listen, when you really look at the technologies car makers have, and then you look at Root smartphone telematics, you can't but not laugh. It's a joke. It's really a joke. And if we're really in the business of preventing risk, if that's what we're here to do, then I need accurate technology that could say that Nick is sleepy or that Nick is really texting, not having his phone play while he's driving and it's perfectly fine because he's not touching it, but the Root app thinks that you're playing with your phone. Now, forget that for a second. Like the fact that they only do it for the 2-3 weeks test drive, they do track you if you leave it open. So they keep that going, but they don't require you to have that in the background. So where's the benefit? Like, where's the benefit of actually getting that telematics setup? Because again, everybody could game the system for 2 to 3 weeks. So this is it. And at the end of the day, Nick, Mitchell, you talk about the type of consumer that comes in the door, wants to be watched, willing to give up their privacy to save some money. If a customer is driven by price and you get them by price, you're going to lose them on price. And when Root increases the rates because they'll have to make their book profitable, then they're going to lose customers. Now, again, it's going to be like that hamster on a wheel. They'll keep on getting new drivers that come into the market that don't know about Root yet. So it's going to continue on and on and on. The real question is, when they go for an IPO and assuming it's successful, what's going to be their next move? Are they going to stick with insurance? Are they going to build out their enterprise product that they have now? Are they going to acquire a company? Or are they going to do other things? I think that's going to be a big question. But
okay, so Mitchell, that's a good question. Maybe the the business model itself is not insurance. Maybe insurance is a minimum viable product to a technological platform that they can then license as like SaaS or something else to the rest of the industry. Is that a possibility?
I think the enterprise model, a lot of insurtechs are trying to take on, and sort of, I think the key thing we talked about earlier in this discussion is, add them all up together and they're not 1% market share. And so it is a big, long climb. I saw something recently, I'm unsure of its accuracy, but I think it had Root at sort of just outside the top 100 P&C carriers, even after all their success. So, certainly mastering the technology and then putting it into marketing machines with tens of millions of customers and billions of dollars in budget, that could be attractive. But it's awfully tough to say, hey, we built this business, we're great at it. Give us your public capital dollars, and we're going to switch and do something different. And so, I think I certainly think that they remain committed to figuring this out, and probably the aspirations are to go from not a top 100 P&C carrier to much higher up those league tables.
Yeah, and I think it should be stated, like, a lot of the negativity you might be hearing out of my voice is just, I'm trying to put myself in the shoes of an investor, thinking of what's the enduring value here. And similar to Lemonade, I'm struggling to see it because I see too many headwinds. I like that word, Mitchell, because I see I see a lot of competitors in the space that are already doing this, that already have bigger names doing this. So I'm going to struggle to sort of give them credit for anything that's distinctive in their technology unless I can like immediately measure it. But their current unprofitability tells me that they can't leverage it, that there's still something amiss there. But then it gets bigger. It's like we don't even know if the UBI makes a difference. We don't know if they're going to be able to get to the entire United States because of regulatory issues, and it could be 50 different types of programs that they're going to have 50 different actuarial models, which means a really tremendous amount of overhead, on the actuarial side. Which, if that's the case, then you still have to give the advantage to the incumbents who already have those systems set up. The State Farm's, Geico's, and the Progressives already have like really well-defined actuarial systems that know how to do all of this. And then there's the Tesla. So you have Tesla, you have other car makers who are going to potentially start offering their own insurance and autonomous vehicles, which, I mean, white paper after white paper is basically predicting the doom of the auto insurance industry. And here's an IPO, and I'm seeing, not that there's anything wrong with them or they couldn't be a very successful company. To me, it's like I don't see any enduring value. Like I don't see anything that sort of stands out that says I should invest my money in this. This is going to be an Uber-like investment. I don't see anything like it. It just seems kind of like middle of the pack. Not an insult to them. Salute to their technology. It's just, as an investor, I wouldn't touch it.
Yeah, I mean, a lot of questions there. I've been fielding many calls from investors who are looking to get acquainted with the company and the industry. Conversation tends to go a lot along these lines. And really, for a company that, again, I think it is worth underscoring, we're only talking about them because they have had so much success to this point. And I absolutely respect that. But there's a lot of red ink there. And there's not a clear path or a clear story they've told on how that's going to turn around. And really, I think one of the things that strikes me as a concern is they've just taken on so much so quickly, from new products to a state rollout that seems to be one every couple of weeks, to just the pace they've expanded that company. It's tough to keep all those things on track with that pace of growth at the same time. And I think one concern I think Warren's calling out as well is with any business, it's the people. And again, highly laudatory to what they've accomplished so far. But and they've been hiring lots of people, and I know some of them, they've made plenty of good hires. But you need to build up so many organizations so quickly with people who understand how to scale. I found it very curious that at a time when the world is getting more global, and in this crazy COVID year, so embracing remote, they are extremely fixated on keeping virtually everybody in Columbus, Ohio, which is extraordinarily limiting to your talent pool, both on the insurer side and the tech side. You've got obviously then an overweighting of nationwide alumni at Root, which has lost some ground in recent years to other carriers. And on the technology side, again, Columbus is a fine city, and Ohio State has created a nice community there. But it's a pretty limited talent pool that they're drawing from. And it's really sort of three stages of company compressed together really rapidly, from we need to build great tech and great marketing, then we need to get smart very quickly in insurance, and now we need to learn how to scale and get to profitability. Just so much going on there in such a short period of time. It reminds me in a lot of ways like the dot-com days of let's just grow and take advantage of a probably record-setting IPO market, and don't worry, we'll grow our way out of negative margins somehow.
Yeah, Avi, we've talked about this. There aren't a lot of successful histories, stories of companies that did have explosive growth in insurance. And I think, generally, we have a lot of years of experience between the three of us. I think it gets to what you say all the time. It's like once you start raising prices, people will then start feeling it, saying, "Hey, what's going on?" And they will start shopping, and you do generally see an outflow of customers. And I think that is, to me, that is probably the single biggest um, issue that these, we'll call them tech companies, is trying to take a tech model where it's like, let's get massive growth. We don't, typical tech venture style, massive growth. Um, you know, we'll lose money, but we'll make it up at some point in the future. And the history of insurance has not been kind to that kind of narrative.
I think I don't think they care. I don't think Root cares. I don't think Lemonade cares. I think their investors, the founders, they could say what they want about being here for 100 years. Maybe their companies will be here for 100 years. I don't think the founders will be around that long. They'll move on. And, I think for them that this is the ultimate success. Going for an IPO, getting to a place where you have more money to play with and your stock can go up and down in a matter of days and hours and minutes. That's a place they want to be in, because obviously I don't know of many insurers that would think to acquire Root at $6 billion valuation. I don't know what company would do that. But this is the ultimate success for them, and good for them. They didn't stop. They went all the way. Not like other, you see a lot of their competitors pivoting, working with agents, trying to do this, trying to do that. They saw the vision. They didn't quit. They went all the way. Who cares if it's profitable or not? Investors are probably going to be sold on the vision, just like with Lemonade. They're going to sell, oh, yes, we're different, we're fair, we're this, we're that. And, again, this is the ultimate success for them. I don't know if they could have had a better outcome. Of course, if they could have been profitable and all that. But, I mean, who's profitable
Okay. Okay.
across
So
the world?
then that brings me to, I think, we've sort of nitpicked maybe Root, and talked about a lot of the headwinds, and given them credit where credit is due. But let's put it in context of other digital startup insurtechs. So Lemonade is, they call themselves a homeowners company. They're looking to do more homeowners. It was in their S1. That's a big part of their, I think they're what they perceive to be their future enduring value is we get them in as renters and then graduate them to homeowners. Root does homeowners, but they also do auto. Then I think of Hippo, which only does homeowners, but they go more vertical in that area. So, I think expectations would be at some point Hippo would also go public. And so just focusing on that, on the group, not just those three, but any of the quote unquote insurtechs that are carrier based, that are doing auto or homeowners or a combination of the two. I still feel like they can all be successful, but they can't all have that massive valuation. Like ultimately, at some point, they're going to be competing against each other, right? And someone that's looking to buy homeowners insurance is going to have a lot of options for a lot of companies that are have that digital DNA, right? And so it's what do you guys think about that? What do you guys think of just look at the insurtech community as they become IPOs? They can't possibly all justify their valuations, and in a lot of ways, they could be an existential threat to one another given their size.
It reminds me a lot. It's all 2014 IPO market, obviously, really making a lot of headlines, on pace to probably be the biggest year ever. And kind of the two periods before that were 2014 and then the end of the dot-com days in 99 and 2000. 2014 is when you had the first fintechs go public, which was my life before insurance. I was at Lending Club where we had the biggest US IPO that year. And I think that record stood for like 3 years. You saw On Deck Capital come out, I think, weeks later, looking a lot like a company that wasn't ready, but taking advantage of the opportunity. You had Rate Setter in the United Kingdom. All three of those companies 5 years later are down more than 90% or no longer independent at a price that was down by more than 90%.
Yeah.
You know, I don't fault Root or anyone else or Hippo, probably the next candidate that says, hey, here's a market that, you know, is receptive to what we have to offer. They would be fools not to take advantage of it. But as you know, those earnings, you know, you've seen already Lemonade down a third quickly, and they still have a lockup that's going to end in probably another 3 months or so, where, you know, there tends to be another pretty good drop from there, especially if the earnings keep looking like they have been. It could be a pretty narrow window for InsurTech. And, you know, that can really set the entire, you know, in a market that has a unending and voracious appetite for capital, that capital can ebb and flow. And clearly with Lemonade and Root riding high, it's a great time, both public and private markets. That pendulum can swing pretty quickly, and I think that might be what we're in for. So get it while the getting's good.
Well, yeah. So Avi, I was having a bit of an online conversation at Seeking Alpha about Lemonade, because someone made a post, and I decided to comment because I'm a glutton for punishment on it. And, you know, I brought up the whole reinsurance aspect of the business and how, you know, as a capital light structure, they're completely dependent on reinsurance. They've essentially sacrificed a lot of the near-term upside, right? And someone actually responded and just said, no, well, that's what reinsurance is for. It's so that they can take on more risk, and they'll just raise more money so that they can have less dependency. But you listen to what Mitchell says, it's like that window could close. Like, and think about that. Think of this as an investor, potential investor into those companies. If they get to the point where they're expecting the public markets to kind of feed their balance sheet, right? That can't work. The economics around that are just like really horrible. And so I'm worried for them. If Mitchell's right, I'm worried for them, because then if the growth at any cost, I think, is going to come at a cost when they need to raise more money to be able to reduce some of their reinsurance overhead or other expenses.
You know, I'll tell you this. I bet you every other InsurTech founder would love to be in the shoes of Root or Lemonade with, you know, challenges. It's just, you know, it really is a perspective. Like, what is your ultimate goal? What are you here for? And just this week, I saw the story of Nikola Motors with the founder, Trevor Milton. Crazy. I mean, if it's true, it's just crazy what you can do by selling a vision that has no relation to reality. So it really, I mean, it's such like great questions, and time will tell if, you know, their valuation will justify itself or not. But you know, it's the biggest question is like, really, what's in it for the insurance industry? Like, what are some valuable learnings you could take from Root or Lemonade? Like, can you take something from what these companies have built, take it back home, apply it, and be a better company, be a better Progressive, be a better Geico, be a better State Farm? Is there anything you could take from these companies? That to me is a question which I don't know if the answer is yes. I don't know.
I don't know. I have an opinion. You have an opinion, Mitchell?
I was going to say, I think that gets lost in some. I think the challenge for all these InsurTech is they have to do everything. They've got to figure out how to build a different product, how to market it, how to build a book, how to price it, how to handle claims, how to reinsure it. They need to do everything. And I think nobody's good at doing everything, especially with very little history behind you. And what that can do is sometimes wash over what they are extraordinary at. I mean, I'm a Lemonade customer. It is truly delightful. I wish I could work somewhere that could pump out product as great as that. It's amongst the best I've seen almost anywhere. And I'm not really used to talking about with delight and a smile my renter's insurance. You know, you look at Root and their ability to acquire customers cheaply at scale through a method that most people didn't realize existed and certainly didn't exist in insurance. It's extraordinary. The challenge is they may be great at those things, but then, you know, there's the other 85% of your business that you need to run. The flip side is if you're a large traditional incumbent, you may have most of those other things, at competent to good, but it can be really hard to innovate. And that's where the challenge comes from. I know, Avi, I saw something you put out, I think it was you a week or two ago as well, about how sort of all of the, internal startups really haven't caught fire either. It's really hard to innovate in a big insurer. It's really hard to master all those big insurance tasks as an upstart. But there's obviously some positive things in both of those worlds. I think someone will figure out how to do it at some point. But it's tough, and I think it's easy to be critical and sometimes deserved of, here's all the stuff they're not getting right, or that is worrisome. But we wouldn't even be having this conversation if they hadn't had just, they've racked up a lot more wins and losses in the half dozen years or so they've been around so far.
Yeah.
Yeah, I think at the end of the day, you say what things they do well, and yes, they do things very well. The thing is, if you look at really the bottom line, that's not a good thing for your business. To lie to customers and acquire them under a certain perception and then upset them, that's not good business. It's good business for an IPO, because by the time they get upset and they write a review online, you're well ahead and everybody's succeeding. But this is the thing. Like, this is where a lot of carriers, they don't want to do these initiatives because they say it's not profitable, it's not worth it. This is not really something that's going to move the needle for me. But you're right. It's easy to be critical, and we're critical a lot at Coverager. I think that's why people like us, I think. But no, I think at the end of the day, the problem is, and this is where the problem I think starts, is when companies like Lemonade and Root, and they say, well, this is how you do it, or we found the right model, and it's about delighting customers. I don't know. I mean, wait a little bit when they increase your rate, and wait if you have a bad claim, and then we'll see if the nice app was worth it. Maybe not. So that's the ultimate question. But again, time will tell. We'll need a lot of more time for these companies to prove that their model was actually better, and in terms of acquiring customers and delighting them and service and all that stuff.
Well, we have a customer right here with Mitchell for Lemonade. So
I'm a customer too. Yeah.
Yeah. Okay. But I know you. I know if they raise the price $1, you're out of there. But Mitchell appears to have been delighted. So I'm wondering, how do you split the world when it comes to Lemonade? How much does price factor into this for you? You're delighted, but what if the price doubled? Would you still be delighted?
Yeah, I mean, I think, renter's insurance is just, to me, such an odd product. I mean, I have a probably pretty lavish coverage, and my premiums, I think, $28 or $29 a month. So, it's not something I think about often.
Did you shop it?
I think I did. I don't recall. I've been with them a few years now. I've had I've had coverage previously, not with them. So not totally new to it. I have not had a claim, so I can't speak to that experience. As someone in the industry of product marketing and insurance, like I absolutely, I envy and think all the accolades that they've earned for their approach to product design, or how they've executed for the brand they've created to support that. Like, it is absolutely top of the game. At $28 or $29 a month, I don't think about it a whole lot. Again, I haven't had a claim.
Well, that's what I think they brought to the table, Mitchell.
Yeah.
Exactly what you described. It's more of a customer-centric mindset for how do we want the product to behave, and I think that's the top skill, or the top priority that they brought in, that I think the industry itself, Avi, has to pay attention to.
But that's what limited Lemonade. I think just this week I saw a filing for Florida for renters insurance. They're a new program. So that's what's limiting them, because they know they cannot deliver this delightful experience when they buy car insurance or like homeowners insurance and doing some massive claims
Do they think that?
I think so. I think they know that they can't go into other lines of business. They're not willing to do what Root does. They're not willing to get tweets about, how do you know if I'm driving? Why did you increase my rate? With Lemonade, everything is positive. That's the thing. Most of their comment, everything is positive because they kept it positive. But again, that's the limit. Because if you really want to grow, you need to get dirty. and that's something that they don't want to do. But they were able to see success being nice. But again, will they ever be able to take on a State Farm or Allstate? Not like this. They'll need to really start to be mean and not care about customers, like Allstate and State Farms. They don't care. That's the policy. We're not covering you, or it's expensive. That's the price. That's what you have to pay. But I mean, two different tactics. And I always find that with tech people, and no offense, Mitchell, we're in insurance. We see these, apps. We like to do them, and I have with State Farm and Lemonade just for business purposes. I find for tech people, we kind of like the tech stuff, the cool digital stuff. But for a person that is buying insurance because it's necessary and they just need it because the landlord said, then they will look for the best price, which happens to be Lemonade still. But I mean, that's what's going for them. The good prices, the nice experience. No way they could have pulled off what Root did, because that really means, doing a lot of stuff that they wouldn't be happy doing.
Yeah, I'll push back on you there, Avi, in that I think establishing a positive customer perception and reputation is enormously challenging in any industry, and 10x in insurance. People love to complain about price changes and real or perceived lapses in claims payouts. And so, I think that's a major accomplishment. I know that every single insurance product team I've ever spoken with has dissected every single pixel of what Lemonade does, yet none of them have been able to recreate it. And so I think it's a very strong competitive advantage they have in both creating that reputation and that quality of product, and having people and process that's able to replicate that. To me, I still find it really curious about having renters as your core product and just the economics there, because the price point is so low. I don't know what the average premium is, but I would guess it's less than $20, and maybe even closer to 10 for most customers. I think I'm an outlier there. It just doesn't leave a whole lot of economics to work with. But being able to deliver that quality of product, that quality of experience, and build and leverage that kind of reputation, I think if you can identify other markets where there's that opportunity, the ability to execute on that's pretty rare, and certainly one that that to me is a competitive moat that is just really hard to copy. And I say that because I've seen pretty much everyone try to copy it.
Well, I can tell you that COVID-19 is not doing well for Lemonade, because from latest research, and this is something they mentioned in the recent earnings call, renter's insurance is a very unstable product, because apparently when you have a pandemic, people go back and move in with their parents. So they give up their apartment, so no more renter's insurance. So, look, at the end of the day, Lemonade did great. A lot of companies tried to copy them, and they didn't go all the way, because, again, I think some of them said, wait a second, I mean, we don't have the capital to do it, or it's just not smart business. For Lemonade, it was clearly smart. IPO, everybody's happy. But if you want to be pretty, then you can be pretty. But if you really want to get to the business of insurance, like I can tell you, I bought pet insurance with Lemonade, and even the basic of, kind of accessing my medical record, my pet's medical record, and reading it in a timely manner to see, that wasn't there. It took 6 days for the underwriter to tell me what's excluded from the coverage. So that's a little more sophisticated product for them, a pet insurance. Just imagine what it would be for them to go into car insurance, when claims like these are serious claims that you cannot do with AI Jim. You just can't do a video when you're injured. This is my problem. So, I mean, but again, at the end of the day, I think Root and Lemonade are a case of great execution, really great execution. They knew exactly what they were doing. They had some hiccups along the way, but they stayed the course, and they're seeing, the benefits, because no one else was willing to do what they did. And I mean, good for them. But now is really, I think, after the IPO, we'll see what they do. We'll see what's happening with Lemonade. Then we'll know where the industry is moving in general, and if there really are elements where companies will copy what Lemonade and Root did.
Okay, well, I think we got to that point where we started to beat a dead horse. So getting close to the top of the hour here. So Mitchell, thank you for being a guest host insights were fantastic. That was extremely helpful. Probably wouldn't be a bad idea to have you back on after the IPO so we can talk about, what did happen, whether it went really well or not. We're going to probably have to talk about that, but thank you. I appreciate it.
Thank you. Thanks for having me. It was a fun conversation, and definitely that Root S1 will be an exciting read.
Yes, it will. It will.
Yeah.
Avi, per usual, thank you. And for everyone out there, this is the week ending September 25th. Please be safe out there. Please subscribe, click the like button, and give us comments and engage with us. If you don't like what Avi said, let me know about it so I can tease him. Anyways, for Mitchell and for Avi, everyone, have a great week. Thank you.
Thanks.
See ya.